Why are all these people laughing and rich? It could be because they know how to use a 1031 tax-deferred exchange. The 1031 exchange technically just defers taxes, but it is possible to use it so that you and your heirs avoid capital gains taxes literally forever, proving that death and taxes are simply for the uninformed. If financial immortality sounds good to you, join me, won't you, for a tour of the Versailles of tax shelters. When an owner profits from selling property and wants to use this profit to buy other property, they usually would pay capital gains tax on this cash profit. To many property owners, this legally qualifies as irritating. A 1031 tax-deferred exchange is much more exciting. As long as you never personally have control of your cash earned in the sale and immediately have this cash reinvested into other property, you did not technically realize a cash profit, and thus you may defer paying taxes on it. You can keep exchanging property like this indefinitely until you finally decide to stop exchanging and take a profit. At this time, you would pay capital gains tax on that profit. Thus, this is a tax-deferred exchange. It is not tax-free, theoretically. But what if you never stop exchanging property? 1031 exchanges are named after Section 1031 of the Internal Revenue Code, which sets forth the rules for these types of exchanges. Section 1031 is immensely complex, though in certain regards it is surprisingly relaxed. For example, it states that you can only exchange like-kind property for like-kind property. This sounds somewhat complicated, except that like-kind refers to any type of real estate at all. It's the owner's purpose in holding the real estate that determines whether it is like-kind. As long as the owner holds the property as an investment or for productive use in trade or business, then that property qualifies as like-kind. Exchanging investment swampland for an apartment complex? Those properties are exactly the same to me, says Section 1031. Want to exchange bare land held for investment for a grocery store that you own and operate? I literally can't tell the difference between those two properties, says Section 1031. 1031 is strict, however, about the owner's cash profit. Regarding this profit, 1031 essentially says, you touch it, we tax it. The owner cannot at any point in the exchange have had money from the property's sale in their possession. The owner must use an exchange facilitator who receives the sale cash and holds it in trust until it is used to buy replacement property. This 1031 exchange trust is called a Starker Trust, named after the court case that created many 1031 rules. Another strict 1031 rule is that the exchanger must identify their replacement property they'd like to purchase within 45 days of selling their relinquished property, i.e., the property to be replaced. This new property must then be purchased within 180 days of transferring the relinquished property. The new property does not have to be one property. It can be 3 properties purchased at fair market value or more properties, as long as their total value is not in excess of 200% of the relinquished property's value. It is important to note that the relinquished property or properties and the replacement property are rarely the same price. Quite often, some of the sale proceeds will not qualify for or be used in the exchange, and the owner must pay capital gains taxes on this portion of the sale. This portion of the sale that does not qualify for deferred tax treatment is called boot. If you haven't yet fallen asleep during this thrill ride through the Internal Revenue Code, you will now be rewarded with the key to financial immortality, which I am about to give you. Remember that you only have to pay capital gains tax when you stop exchanging properties and take a profit. If you never stop exchanging like-kind properties, you may never pay capital gains taxes on their sale. But What about my heirs who inherit my property? You may ask. Surely after I die, my heirs will have to pay capital gains taxes when they sell my property for a profit. First, how selfless of you to be worried about your wealthy children. Second, you're completely wrong. Your heirs will likely not have to pay capital gains taxes on your property, even if they sell it for a cash profit without a 1031 exchange. Your heirs will likely not pay capital gains taxes because of a concept called stepped-up basis. Say you bought a property for $100,000 and sold it for a fair market value of $900,000. Your original basis in the property would be only $100,000, so you would owe capital gains taxes on your $800,000 of profit. But if you die without selling the property, and your heirs inherit this property and sell it for $900,000, which is its fair market value, their basis is stepped up to the property's fair market value. Your basis in the property would be only $100,000 in this example, but your heir's basis would be $900,000 since it was stepped up to its fair market value at the time of your death. Thus, if you buy and sell increasingly expensive like-kind properties your whole life, you will be able to enjoy the income these properties generate, for example, rental income, of course, and you will be able to borrow money against them. If you never stop exchanging property under 1031 rules, it is possible that you and your descendants will never have to pay capital gains taxes on these properties. If you want a tax shelter that transcends space and time, the 1031 exchange is for you. There are many other rules essential to a 1031 tax-deferred exchange, so it is important to seek the help of legal and tax professionals in this process. It is not a good idea to do your own artisan handcrafted version of a tax-deferred exchange. It is also not a good idea, or legal, for a broker to give tax or legal advice on 1031s, or really at all. However, understanding how they work can give you a competitive edge as a broker and is also important for the real estate exam. I hope this was helpful. I'm Ethan Atkinson with Online Ed. Thanks for watching.